Welcome to the Money Management course. In this video, we will talk about how to use the Martingale method of managing capital to minimize your risk. The Martingale method is the most controversial strategy for money management. Many consider it to be excessively risky, but by sticking to a conservative version of the Martingale method, you risk no more than with any other strategy. In essence, the method is, following an unsuccessful trade, you should increase the investment amount of the next trade in order to have the possibility of covering your losses. The Martingale method usually consists of 4 to 7 steps, each of which increases the trade amount by a certain value. If you are aiming to compensate for your losses, the amount of your investments in each subsequent trade should be proportional to the losses incurred. After a new trade successfully closes and you've covered your losses, you can then return to the original investment amount. Let's have a look at an example. You open a trade for $1 and it closes in the red. For the next step, you open a trade for $2. This trade fails too. For the third step, you increase the trade amount to $5 and it again closes in the red. For the fourth step, you make a trade for $11, but this time it closes in the black. If you take into account the 80% profitability, your option premium from the trade is $8.80. Accordingly, you have covered the $8 that was spent in the previous steps and made a profit of 80 cents. Traders who distrust the Martingale method tend to be using it incorrectly. Remember these few important points. Don't make calculations based on your entire balance. This is a big mistake. Plan to use the method as follows. Even if trades at each step close in the red, you should lose no more than 6% of your total balance. Choose a fixed number of steps. The method traditionally uses 4 to 7 steps. You can choose your own number. The main thing is that the trade amount at each step should not exceed 6% of the total balance. Meaning, if your balance is $100, 6% is $6. Therefore, $6 should be the maximum amount you invest on a single step. Trading using the Martingale method requires a fairly large balance. In order to create a 5 to 6 step plan that will not exceed 6% of your balance, you need a substantial starting amount in your account. Do not trade using the Martingale method if you only have a small balance. Doing so would most likely result in losing your entire balance. Stick to these rules, and the Martingale method will become an effective aid when managing your money. In the next video, we will examine the finer points of the parlay system. Stay with us and level up with Stocksup.